Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/thesmattering, to get access to the 10 best stocks to buy right now. Plug Power just reported earnings, and that 49% revenue growth probably has some people excited. Then you listen to the story of the future of hydrogen, the potential growth, and you might be getting even more excited and looking at Plug Power as a stock to buy on the dip. I'm Jason Hall. This is The Smattering. I think hydrogen definitely has a bright future in providing for the world's energy. But there are some numbers that anybody that's interested in buying Plug Power need to know if you are considering owning this company. I've got Tyler Crow here with me to talk about it. Hey, Tyler.
There may be a future for hydrogen. I don't think Plug Power is going to be part of it.
I'm not going to be so quick to say they're not going to have a role in it. I will say abundantly that my question is whether that role is going to generate any returns for shareholders. Because if you look at the economic results, and if you're a bull on this company, please send all the comments you want to us. But I implore you, please don't just leave the video right now and start shouting at us with your keyboard. Watch the video, because I'm hoping to maybe kind of shake a little bit of sense into a few of you there. Tyler, you go first.
Sure. So Plug Power bulls are generated every 2 or 3 years or so when people hear about this company and they think it's really excited. And then they follow it for 4 years and realize, oh, maybe this isn't what I was looking for originally, because this has been a very reoccurring pattern with this company for a very long time. Revenue growth has been a thing they've been able to generate. I'm thinking back of the first time this company really took off, probably 2014, 2015. They made a major announcement.
Partnerships with Walmart. There's been partnerships with
Walmart,
Amazon over the years, I believe. You see, I'm showing on the screen right now, you follow this chart, you go all the way back to 2000 when the company went public. It kind of bounced along at around $10 million, $15 million in revenue for a long time. And then, like Tyler was saying, right in here, we saw it substantially grow. This is the COVID crash, right? So let's adjust for that reality. It's a $700 million company, right? So this is not nothing, right? They're selling stuff. They are selling.
Yeah, they're selling something. But the question is whether that has actually ever translated to anything remotely assembling a scalable, profitable business. And that just hasn't been the case. The entire time that it has been scaling up, there has been this expectation that if we generate enough sales, we'll become break even, either break even on a gross margin basis or break even on an EBITDA basis. I can remember, I think, a conference call back in 2014 where it said, we're going to be EBITDA break even by 2018. We're 5 years later, we're still not there yet. But even in this most recent quarter, I want to make sure that I get that number right, but it's somewhere in the 28 to 30% negative gross margin range.
I think this is worth adding some context to, Tyler, because let's talk about like the stack of different kinds of margins and what they mean. Sure. And we'll start with gross margin, right? Because this should be the highest margin. This is the best margin, because this is you're taking your thing that you sell, the revenue you sell it for, and then you subtract out cost of goods sold, which is all of the inputs, the labor in your manufacturing facility, those manufacturing costs and shipping costs, and then you take that out. And what's left over should be your gross margin, right? So we haven't even included covering the cost of marketing, your home office, R&D, any of those operating expenses. We haven't covered capital expenditures, right? So we haven't covered CapEx or operating expenses at all. And this is a company that in its history has generated positive gross margin for really no real extended period of time. And the vast majority of it has been negative gross margin, meaning that they are actually selling the products that they sell and the services for less than it costs to produce them.
Where they manufacture hydrogen, they also manufacture fuel cells, primarily for indoor applications of things like forklifts. I think they've tried to get into fleet delivery vehicles with limited success.
The news story is something that, again, I do think it's going to be a pretty big part of the hydrogen and the green economy going forward, and that's electrolyzers, right? So the idea is that you can generate green hydrogen by taking power from wind or solar, or hydroelectric, some non-carbon fuel source, take electricity and use electrolysis to separate the oxygen and the hydrogen. And now you have hydrogen, you have oxygen. Those are the two things that come out of it. And this is their new thing. This is their latest thing, right? And they've signed some big deals. But the key to me, Tyler, and I want to stress this, is that Sure, maybe there is some future where they're going to be cash flow positive. They're going to generate positive gross margin. They're going to generate operating margin, but they've never done it in the past. And they've done these pivots before to other things and never done it before. They never, ever, ever turn profitable. Like even at the gross margin level.
There's another kind of telling pattern for me that if you've studied this company for a long time, you've noticed, and that what will end up happening, and it's happened several times, where they'll make one of these announcements, this major pivot or a major deal that they sign, or something that really makes it look like this company is going somewhere in the very near future. It causes a huge spike in price. The CEO sells a boatload of options or stock that he's gained over the years through stock options. And then they immediately do a dilutive secondary offering to fund the development of this exciting new thing. Puts cash in the bank, allows them to keep bleeding out negative gross margins, negative operating cash. In my 7 or 8 years of following this company, I can think of at least 5 times that this exact pattern has happened. And it is very indicative of what management thinks about its shareholders. And if you're bullish on a company, you can be bullish on a trend. You can be bullish on hydrogen as much as you want. I think that's great. But you also want to have a management team that's actually aligned with your interests. And one thing that Plug Power has displayed for years upon years upon years is that management is willing to pay themselves on the backs of its shareholders.
I want to illustrate that with evidence. This is shares outstanding. Every time you see one of these big increases, this is a secondary offering. This is every time in the past the company has gone to market and issued more shares and sold them to raise cash. Again, we're talking about a company that 2008 had less than 10 million shares. It has almost 600 million shares. This is how the company has raised cash to continue funding its operations, to continue paying its executives. And as you said, Tyler, has generated negative returns. And retail investors, they've been really good at telling that story too, but has simply not created any value for investors. As a matter of fact, has taken money from shareholders and destroyed a lot of value.